Hello everyone, my name is Harry Thompson. I'll be running through this fund manager report for the third quarter. As always, the quarterly report is available in text version on the website. If you wanted a copy, please contact someone from King Shaxson and we'll be happy to get that sent over to you. The quarter will be remembered as the quarter that finally delivered, as the eagerly awaited interest rate cuts in the UK and the US finally happened. It's hard to believe that it was just under a year ago, in October 2023, that market expectations for interest rates finally pivoted from rates still rising to having peaked and maybe even beginning to fall. The chain reaction in the market from that pivot led to expectations that ebbed and flowed until the end of the first quarter of 2024, and over the last 6 months these expectations have turned into the final reality. This has had the expected positive effect on portfolio performance, and we will look at this in more detail. As we enter the final quarter of 2024, we are confronted with significant political events, more economic uncertainty, and a more mixed corporate outlook. Taking each of these points in turn, in November we have the last big election of this jumbo political year, with the US presidential election. Some months ago it looked like a certain Trump victory, but the rise of Kamala Harris, following Biden stepping aside, has created an element of uncertainty. You could argue that her support in some key states has swung the pendulum back into the Democrats' favour, but it is still a very close call, and a month is an eternity in politics. The geopolitical implications of this election cannot be understated. Closer to home, the new UK government has not started well. Poor communication and concerns over the agenda have not helped. The budget on the 30th of October is expected to have significant ramifications for investors. Pension allowances, inheritance tax, capital gains tax and investment decisions are all open to uncertainty, and the UK bond market is paying the price. We should expect any fiscal tightening to maybe accelerate monetary easing. In layman terms, higher taxation may mean lower interest rates, but we could also see the opposite of that, which highlights the uncertainty. The US economy continues to perform strongly, whilst Europe, Japan and the UK continue to struggle along, and China has remained a source of concern, not growing as fast as it had been due to real estate issues dragging on the economy. India continues to emerge and remains the focus for growth in a large global economy, and its financial markets continue to slowly open up and gain more of international attention. China has recently made some strong efforts to rekindle its economic growth, and this will demand a great deal of global market attention in the short term. Dumping in certain sectors, such as solar, which did end this quarter, as well as steel, have serious consequences in those sectors, as well as adding to more complexities to geopolitical tensions. This will be a key issue should Trump come back into office. The fate of the US, UK and EU economies in particular will dictate market expectations on interest rates over the coming quarter, and especially in November as central banks meet again. The final point is corporate results. At the time of writing, the strikes at Boeing, railways and ports in the US are having ramifications on the economy and the companies and supply chains concerned. We expect results to be more mixed as a result. Two very hot sectors, the Magnificent Seven stocks that drove the equity rally of 2023, has slowed, but their results will still be eagerly watched in mid-October. At the same time, large pharmaceutical companies that benefited from the anti-obesity drug have also seen some profit-taking as expectations and competition rises. All eyes will be on corporate reporting and the CEO outlooks. This has been a strong quarter for portfolios, building on the improvement we have increasingly seen since the large rally at the end of 2023. In fact, looking over the last 12 months, the first half was mixed, but since March 24, we have seen a more sustained recovery. Two factors lay behind this. Firstly, interest rates, including the pivot, the final reality of falling interest rates, and more importantly, interest rate expectations. Secondly, the broadening of market buying from just a small number of stocks, notably the M7, defence and banks, to a much broader rally across the whole market. Global small caps outperformed large caps on the quarter, with one leading index highlighting a divergence of around 4%. Whilst increasing fixed income exposure over the last 18 months and incrementally adding duration over the last few quarters, we have been hesitant to increase the interest rate risk dramatically. The rationale is based around deficits, supply and demand of bonds, and the ability of governments to control debt. The UK bond market has suffered as a result of budget posturing, with spreads versus government bond markets widening significantly. Shorter dated bonds have been far less volatile, but yielding more, and these have performed the function we want from bonds. Green and sustainable bonds, where we have more exposure, have outperformed UK corporate bonds. An ETF tracking the leading green bond index returned 408 for the quarter, versus sustainable UK corporate bond funds returning around 2 to 2.5%. At our rebalance in July, we added the Aegon Global Sovereign Bond Fund, given our desire to improve credit quality within portfolios, and this returned 4.27% over the quarter, or 2.62% since inclusion. Falling interest rate expectations really benefited the portfolio's infrastructure exposure. These investments actually continued to perform well as interest rates increased in the first half of 2022. We continued to hold on to them as most of them had fixed or hedged their interest rate exposure and were not excessively leveraged. The black swan event was the Liz Truss budget in September 22, which really damaged these investments, effectively killing all development pipelines and creating a surge to safer assets. At the time, short-term T-bills were offering in excess of 6% and effectively destroying any new investment case in infrastructure. As close-ended investments, the market price was determined by market forces and not the company's valuation. The discount between the two was too wide, and over time we felt this would narrow. This has happened over the last 6 months, leading to a strong but varied recovery in property and infrastructure-based investments. Foresight UK infrastructure returned 6.53% in the third quarter. In most cases, this still feels like a partial recovery, as interest rates fall further and the political and supply chain concerns around infrastructure abate. There still remains further recovery potential. The need for renewable energy remains stronger than before. Whilst renewable energy infrastructure enjoyed a recovery, the fortunes of the equities in the sector have been more mixed. July and August returns were largely mixed for companies exposed to the energy transition theme, but a stronger recovery in September following the Fed rate cut pushed a number of funds into positive territory for the quarter, where a leading clean energy index returned 2.97%. This volatile period is depicted in the graph to the left, showing portfolios' exposure to the Robeco Smart Energy Fund. Longer term, the performance of renewable energy equities remains comparable to the oil and gas sector. A leading clean energy index has returned around 96% over 10 years, almost exactly the same as a global oil and gas index. But the journey over the last 10 years has been very different, and renewable energy is still down from its 2021 peak. Even though the outlook for renewable energy remains positive, with no fears of stranded assets, geopolitics continues to play a role, and 2024 was impacted by tariffs and dumping in the solar sector that China dominates. Previously, this had been a negative on US-based solar producers until the practice ended in May. Healthcare declined in September, with Polar Capital Healthcare Opportunities returning minus 4.69%. However, we had taken some profit on this back in July, and despite this fall, the fund is one of the better performing in the sector year to date, returning 13.93% in 2024 to the end of September. Meanwhile, portfolio's water and waste exposure returned a modest low single digits for the quarter, after a particularly strong month in July and then mixed fortunes for the remainder of the period, which is largely in line with leading indices exposed to this theme. Following the bout of Chinese stimulus, equities exposed to the region were buoyed. Major Chinese equity indices hit bull market territory, returning over 20% in the quarter. However, if you take out the last week of the quarter, returns were only in the low single digits, highlighting the wave of money that moved into Chinese equities in the last few days. Over the last few rebalances, we had been incrementally adding to our Chinese equity exposure, so portfolios did benefit from this move. A new fund addition in July was Ebbed Global Emerging Markets Fund, which was more exposed to China, and this returned 6.95% in September. The last year has seen a change in the dynamics for more positive investments, as the interest rate scenario and market dynamics have moved back in their favour. More is expected from central banks around the world. The immediate pinch point for all portfolios and markets in general remains the end of October and start of November, with the UK budget and the US election presenting very different but potentially material risks and uncertainty. Whilst Trump will try and distance himself from environmental policy, key Republican states have benefited from policies such as the Inflation Reduction Act, and he failed to revive US coal last time he was in office, but risks remain. Public spending will be in focus in both the US and the UK, which comes on top of the scrutiny on other major economies, hence our reasoning to aim at the shorter end of the curve. Thank you for listening to this third quarter update. If you need to contact anyone from King Shaxson, you can find the contact details on the screen now. Thank you.